Trying to get your startup funded? Is all you hearing from investors crickets? How can you get an angel investor to fund your startup? Many startups are so focused on their product that they overlook creating a business model and funding presentation that can actually get them funded. We are going to discuss how to get your startup funded on this ScreamingBox podcast. Please like our podcast and subscribe to our channel to get notified when next month's podcast is released.
Can you hear me now? Can you hear me now? Can you hear me now?
ScreamingBox Technology and Business Rundown!
Looking for $100K for your startup? What can you do to ensure that you get the startup capital you need to make your business come alive? Welcome to the ScreamingBox Technology and Business Rundown Podcast. In this month's podcast, I, Dave Erickson, and my co-host, Botond Seres, are going to find the money by talking to DC Palter, founder of PitchingAngels.com. DC is an angel investor, a startup mentor, and a published author and novelist. He has invested directly in about 37 companies over 10 years, and he's invested in hundreds of others through two angel investor groups he's a part of, the Tech Coast Angels and Chemical Angels Network. He started his career as an energy engineer, and energy sustainability remains his passion. Even though most of his working career and his two successful businesses that he built were actually in the computer networking industry. Today, we're going to discuss angel funding and how you can make a fundable business model and a winning funding presentation. So, DC, an impressive resume.
Well, thank you.
Anything you'd like to add?
Oh, well, I've done a lot of different things. Got a lot of gray hair to show for it, too. So it's kind of hard to summarize a long career in a paragraph, but I think that does a good job of it.
Great. You obviously have a lot of experience in funding businesses, particularly at the angel level. So we're kind of excited to explore that. I think maybe
And thank you for having me on today.
We're actually happy to have you.
I'm looking forward to this discussion.
So Botond, anything you would like to start out with? I know you've been involved in startups and kind of getting businesses together a little bit. Maybe you have some funding questions?
Let's say that I tried. Haven't yet succeeded. But it strikes me as quite peculiar, DC, that you started out as an energy engineer, and it's not typically a path that people take to then become an angel investor and a startup mentor. So
No, it's been a long and winding road, but that's not unusual at all. So I started off in energy engineering because I wanted to work on energy sustainability. There weren't any jobs in that. So I ended up working in the defense industry. I ended up working at a steel company, went back, got my MBA. And where were the jobs in the 90s? Well, it was in startups doing, it was a dot-com bubble, right? So, and I'm in California. So ended up at the startup doing computer networking, and I loved it, right? After working at big companies for, at that point, it was already about 10 years. Like, wow, this is so much better. You get to do everything. You get to be part of a team. You get to see your success. You get to, talk directly to customers. So it's just very different from the, being a small cog in a big machine at a big company. I just really loved the small business. And, but every day is a struggle, right? Big company, you're going to get a paycheck. Startup, you never know, right? If the product doesn't succeed, then you move on to your next thing. And there were a couple times where we had to pivot. We had to find something new. Company ended up being acquired. And what did I do? I started my own startup after that. Did that for a while. Everyone thinks, oh, it'll just take a couple of years. I'll have the product out. Then I can, then I can be rich or retire or go play golf or start my next startup. The first one took 10 years. The second one took 13 years.
Wow.
So it takes a while. And at that point, I was able to sell that business and then focus on my writing, which is something that I had always wanted to do but never had the time to do, while working with startups. Instead of building my own this way, instead of doing one for 10 years, I can help mentor startups, get them started. I can do 10 of them over the course of a year, just not a full-time job, and then also be able to contribute by helping them get funded and get off the ground. So yeah, it's kind of a strange course, and it's kind of come full circle that now that I have some flexibility to decide what I want to work on as opposed to where the jobs were, I can focus my investing and my start mentoring, particularly on companies in energy sustainability and climate tech. So that's been rewarding,
Oh,
at least on the personal level, not so much on the financial level yet. So still
yeah, that's
working on that.
understandable. I mean, but there are a lot of government grants these days for energy sustainability, I would think. Like, especially solar
Yes.
is huge right
So
now.
yeah. That is actually, I think that's something really worth digging into, and I think we're probably going to talk about it more, but how you get started with a business. And kind of the usual way that everyone has, this myth that everyone has is, I had a great idea, I'm going to put together a business plan, I'll put together a pitch deck, I'll go talk to investors, they'll give me $2 million, and I'll go off and
Yeah,
build
I
it.
wish.
And,
Yeah.
that's fine if you've already built two and you've made the VCs $1 billion, and they're like, sure, yeah, whatever you need, here's a check for, a couple $1 million, no big deal, and we'll sure you be successful. But if you don't have the experience, you haven't done it before, they're going to be like, well, show me that you can build it first, show me the customer base, show me your expansion, and then you have the catch-22, right? I want to build. I need money to build a product, but I need to build the product before I can get money. And this just comes up over and over and over again in early stage startups. For software, which is probably 80% of the successful startups you see, you can bridge that gap by working weekends, working night times, by kind of having a few friends put together something that's good enough to get out in the market till you can get a few customers, and then you can get the funding to be able to hire a full team and really build it out. When you're talking about sustainability, energy sustainability, hard tech, batteries, green hydrogen, new fibers, new way of producing, methane, whatever. You can't do that. You need a factory, right? You're not going to build a factory on the weekend in your spare time. So fortunately, there are a lot of government grants around different things, and one of them is energy sustainability, where there's quite a lot of government grants. The U.S. has a program called the SBIR, which is really wonderful. It depends on which agency you're getting it from, but typically you get like 250,000 to kind of build your prototype. If that's successful, then you can get $1 million to work on the commercialization of it. And then
Oh, but what happens if it doesn't work out?
doesn't work out, then you go work on your next thing, right? There's really, the government's putting money in for you to do the research and to see if there's a business there. And that's wonderful. There's different programs. So the Department of Energy is going to be big in energy sustainability. The Defense Department's probably the biggest with those grants. If you have something that's somehow related to national security, whether that's energy related because it somehow helps the military, or whether it's more traditional defense related things, they will fund that. If you have some medical technology, then the National Institute of Health has grants. The National Science Foundation has grants that are kind of more related to kind of science in general. But there's a lot of overlap between these, and you can get multiple grants, not for the same thing, but for different aspects of what you're working on. So if you're building a hard tech company that you actually you need to do research, you need to buy equipment, you need like full-time engineers actually working on things. That's a really great way to get started instead of going out to investors first and say, give me money to build it. That's US specific, and it's run by the government, so it's very bureaucratic. There's lots of special rules. It's got its downsides, but it's almost like free money. And if you're doing a hard tech startup, that's absolutely my recommended way for people to get started.
I've actually gone through an SBIR grant
Okay,
application for solar.
right. Yep.
The process itself and
Hmm.
producing the grant, even if
Yes.
you don't get the money, it's
Yes.
actually a really beneficial process because it forces you to
Okay.
really get a lot of your information together to get kind
Yes.
of what you're trying to do, what you're trying to achieve, why it is different, why it is good. It was a great process. It was very lengthy. It took a lot of
Uh-huh.
work. It's not an easy thing to submit,
Yeah.
but it actually, even if you don't get it, was very valuable in helping with putting a business model together and maybe that's where we can start, DC, with you.
Hmm.
You know, I don't think a lot of people, as they're inventing their newest product or developing software or a hardware product, is thinking about what is my business model or how does my business model, why would somebody fund my business model? So maybe we can start there.
Yeah. So, and that's where they need to start. So I like to invest more on people who come from industry and say, this is a problem that needs to be solved. And our company has this problem. Everyone else in the industry has this problem. Our business is not going to solve it. It's not our core thing, but I know how to solve it. So I'm going to leave. I'm going to do my own startup. I'm going to build it. And that is a story I really like to hear. What I hear more often is not wrong, is nothing, it can work, but it's, I've developed this great new technology. Now I'm going to try and find a market for it. And that tends not to work as well. We call that solution in search of a problem, or technology in search of a problem. And you get that from a lot of, the researchers like, invented this great thing. There's a million uses for it. And we're like, okay, but what is that one use that people are going to drop everything and say, I need this right now. Here's some money. And so I do like to see it working the other way. But even if it doesn't, you need to be thinking about the business from the beginning. And this is something else I think a lot of young founders don't really get. It's not about the product. It's not about the technology. It's about the business. And it's about for investors, it's not even about the business. It's about the investment. Or how are we going to make money out of it when you're pitching to us? So a lot of times from very early stage startups, I hear a pitch that is either about the technology, like it's great for a grant application, or more likely, it's about the product they've developed and how wonderful it is and how these features, and then a couple of slides about the team and so forth. And that always kind of leaves me like, okay, that's nice, but if I'm putting money in, how do I make a return? And that usually hasn't been thought through. So that's kind of one of the keys to a good pitch is don't pitch your product, don't even really pitch your business. You're selling something. You are selling stock in your business. So when you're talking to customers, you pitch the product. You're going to tell them how it's going to solve their problems. When you talk to investors, you need to pitch on why why this is going to be a great investment for them. And so what you're selling is stock in your business, and really don't forget that. And the reason the stock in the business is going to be worthwhile is because somebody else is going to buy the business, or it's just going to be so big that you can do an IPO. But in most cases, for niche products, it's going to be somebody's going to buy the business, who's going to buy it, how much they're going to spend, what are the milestones to get there. And they're going to buy it because you've invented something great and you have a great business. So that's part of the story, but it's leading up to this being a great investment, as opposed to, yeah, we've got this great technology, or we have this great business idea.
It seems like, if the presentation can start out with something like, I was trying to do this, and every time I tried to do it, I ran into these problems. So I
Yeah.
thought about it and figured out that if we did this instead, it would solve the problem. And I go talk to a bunch of people in the industry, and they all agree that if we had this, it would be wonderful. That's probably more interesting than I
Yep.
invented something and I'd like to get it funded.
Yeah. Yeah, absolutely. That's the beginning of a good pitch. Here is a problem that I struggled with, and I found a solution for it because no one else was doing it, and because I have some unique skills that nobody else has. And there's a million people just like me who have exactly the same problem, or there's like 100 big companies that are going to spend $1 million a piece on it. So that's usually the beginning of the pitch: problem, solution, market size.
If I already got
Yeah.
a problem and a solution, and a market strategy that works, so I'm already turning a profit and expanding, then why would I want to sell my stock? That's the eternal question, I feel, in investing.
Right. So bootstrapping is a really good way to go. And I always tell entrepreneurs, do not dismiss bootstrapping. If you don't need money, don't take money. If you don't need investors, why would you want them in your business all day long?
Right.
If you can grow the business yourself because you're generating revenue that is sufficient to grow the business, absolutely, that's the way to go. But in most cases, what happens, so take software, you've built it in your nights and weekends, and you've gotten some customers, but you don't have a sales team, you don't have a marketing team, you barely have a website, you don't have designers, you don't have a customer support team. So you're going to need a couple $1 million to actually build a functional business at that point. Plus, there's probably 100 features that you haven't added yet. You just have an MVP, a very basic, almost a prototype of the product. So people are buying it, so that's great validation. But that's, if you can go from there to the full business, that's great. But most cases, you won't be able to. So that is your validation that there's a real market. Now we can go out and get that $2 million from investors. So I can go off and hire a full team. That'll last typically about 18 months till we get to the next milestone where we have $1 million in revenue. If we have $1 million in revenue, we can get another $5 to $10 million in funding, and then really, just hit the market with all of the with all the salespeople, with all the marketing, with kind of everything to get the word out there, because no one's heard of us, right? So marketing is always tough, and it takes a lot of money. So that is kind of the typical way things go with venture capital. That you build a prototype, you get into you get to first customers, first revenue, that gets you money to be able to build a team. Then you get to a decent ARR, and that gets you the money to really kind of build out the business. That again is not the way you have to do it, and if you can do it yourself, either from your own money or from customer money or from grants or whatever, then you have a lot more flexibility, because the challenge is if you get investor money, a lot of people don't get this. And unfortunately, this is kind of like the key, right? If you take investor money, what does investors want to make? Why are investors giving you money? Because they want to make money, right?
They want to make more money, specifically.
They want to make more money, right? And we work from the assumption, if we're working with early stage startups, that probably 90% of them are going to fail. The 1 out of 10 that succeeds is going to take about 10 years to succeed. To get our money back, just to get our money back, we need to get a 10 times, across the whole portfolio, we need a 10 times return. Okay, so we're not talking about making 10% per year. We're talking about a big check being written for 10x just to get us to break even. We wouldn't actually make money, and we're in it to make money more than investing in real estate or investing in public stocks. I mean, anybody can buy Apple or Nvidia or whatever, and the nice thing about those is goes up, goes down, we can sell it tomorrow. We can get our money back, we can do whatever we want. You invest in a company, you don't get your money back until the company is acquired, does an IPO, and that's typically about 10 years. So very high risk. So we need a very high return to make up for it, or else, what's the benefit of investing in startups instead of Nvidia or Apple? So, or real estate. So we want 100x return. Ideally, we want one of the companies in our portfolio to just absolutely kill it and give us 100x return. That sounds crazy, but if you're investing in a company at a 10 million valuation, they invent something incredible, they're successful, Google buys them out for $1 billion, that's 100x return. If they go public, it can be 1,000x return in the end as they keep growing. So it sounds crazy, but that's the returns we're looking for. Minimum is more like 25. So if what you're building can't generate those sorts of returns, then you can talk to VCs all day, but they're going to be like, yeah, this isn't really for us. This isn't a venture investment. So what the pitch needs to do, again, is show how they're going to make money and show how they're going to make a lot of money. Because this is going to be the one, out of their portfolio, out of all those 1,000 decks that they see, this is going to be the one that's actually going to kill it and make a return. And that's what you got to convince them of. Otherwise, this is, I think, the part a lot of people are missing, there are other ways of funding your business. If you are not building a rocket ship, if you are not building some incredible technology that's going to grow like crazy and be acquired for some huge, outrageous amount, then venture capital is not the way to go, because when you take venture capital, that's what they're looking for. And then they're going to be on your board. They're going to own part of the business. They are going to be pushing you day after day to grow the business as fast as you can, to get to that exit as quick as you can. Because the earlier they get the return, the higher the returns.
Wait,
so
hold
that
on,
is the
just a
deal you're
second,
making with
see.
them.
Well, one thing
Yeah.
that you got me extremely confused there. So what I know about venture capitalists is not much, aside from what you told me.
And most people don't,
Yeah,
right?
usually
It's kind of a
I
specialized
just
world.
watch Shark Tank and stuff like that. And
Okay. Yep.
every time they want somewhere around 50%, which means that they are on the board. And I believe you just said that VCs are not usually on the board.
So we need to make a distinction with Shark Tank. People think Shark Tank is venture capital. It's not.
All right.
And Shark Tank is operating partners, and those are a kind of different investor. They're they can be a little bit of both. Sometimes they do investments in some of the rocket ship, but you'll notice they mostly invest in small businesses that generate nice returns. But then they work out these really complicated deals where they get their money back out of the cash flow, and then they get some royalty on top of it, and then they own some percent, and maybe they own 50%. They don't tell you this, but they charge you. They end up doing your marketing. For all of those referrals they get to Bed Bath and Beyond, or wherever, and they help you set up your Amazon thing. They charge you for that.
Oh.
So they are really then a business partner. And that's not the way venture capital works. Venture capital gives you a check. Usually, one of the VCs will be on the board. And as you go further and further rounds, there may be more VCs on the board. They won't own 50% at the beginning. They'll be like 20%. And then you'll do another round. It'll be more like 40%. Eventually, when you're a billion-dollar business, they may own 60% or something like that. So they may end up with control, but we're not really out looking for control of the business. We don't want to be in your face every day. We want to give you a check, and then 10 years later, you come back and give us a big check. Because
That's the dream.
we're investing in 10 companies, 20 companies, 100 companies at a time, right? So
Right, they don't have time to be on all those boards.
Yeah, we can't be on all the boards. We can't, and we're not experts in that space, right? So our business is to give you money and for you to give us money back. And the way we're going to do that is to have our incentives aligned. When you go, have a huge exit, you're going to be a multimillionaire, you're going to be a billionaire, and we get a nice return too. So there's a lot of things in place to say you don't get a nice salary, you don't get a fancy office, you don't get any of those kind of perks of having a successful business until we get our money
That's
in
also
the
a
exit
huge
too.
misconception in general, I would say.
Yeah.
Like
Yeah.
perpetuated
So-
all throughout TV. It's like first thing people do when they get a VC investment is buy the huge
Yeah.
office or rent it or buy a new house, all that.
Yeah, no, you're working for what we call ramen wages, because if you're making a nice salary, then you have no incentive to grow the business and get to an exit quickly. So we want you lean and hungry. Yeah, your staff may have to be paid a salary, but we also want the key people to be paid in equity as much as possible, and not use the cash. We want to use the cash as little as possible for things like marketing.
Angels and VCs are looking for particular types of business models.
Yep.
I know on the VC side, they're looking for a business model that, realistically in 10 years could be a $100 million or
Yep.
$500 million kind of company.
That kind of rule of thumb is you need to get to 100 million in 5 years, or at least have a plan for that. And nobody actually makes it, but that
Right.
needs to be the story, that we're going to get to 100 million, because that's where you're at 100 million, you're a good acquisition target. So, and with no acquisition, we don't get anything. So we want to make sure you're going to be an acquisition target within 5 years. Realistically, 10 years is more likely, but that's what the pitch needs to show. How are you going to get to 100 million in 5 years?
And is that
Physical.
pretty much the same with angel investors as well?
Yeah.
Okay.
Yeah, so that's kind of this other misconception of angels are just these rich people like Shark Tank that will give you money so you can build your small business, and that's not the case. We are early stage venture capitalists, right? Now, your first round of funding is often not your traditional angel investors who are looking for a financial return. They're going to be friends and family. We call it the friends and family round, which is, as it says, is your friends, your family, whatever money you can get together. If you have rich Uncle John who can give you 500K, wonderful, great. If you don't, Kickstarter or whatever, kind of grab as much whatever money you can put together. May not be very much, but at least the more you have, the more you can hire outside people to do the things you can't do. And then sometimes there's kind of this intermediate stage before you get to what we'll call financial angels who are investing to get a return. There may be other motives, social impact, energy sustainability, but this money is coming out of my retirement fund. So I needed to go back into the retirement fund or my wife is not going to be very happy. So I am looking for a financial return along with impact and change. But there are a group of investors that are also called angels that it gets confusing, that are people who are not really advertising themselves as angels. They're not out looking for deals. They are people who are in the industry. They are people who, when you tell them what you're doing, they're like, yeah, somebody needs to build that. And they may be advisors, they may be mentors, they may give you introductions, they know the business, they understand what you're doing, they think it's great. You haven't built it yet, but they can tell you exactly what they think it needs to be. And they may invest. Or they may have other friends. So if this guy who's an industry expert says, Dave, that is the greatest thing I ever saw, and I'm going to introduce you to DC, he comes to me, I'm like, yeah, I don't know Dave, I don't know the product, but this guy who knows the industry says this is the greatest thing ever. Well, then okay, yeah, I want to know more about it. So there is a group of people, I think we'll call them industry insiders. They can be customers. A lot of times they're customers. Sometimes they're suppliers that really know what you're doing. They think this is a great idea. Maybe it solves a problem for them. Maybe it'll give them a new product to sell. Maybe they just want to see it built because they want to see energy sustainability or whatever you're building. Or it may be that they've built their own startup before and now they're like, okay, yeah, this is the next generation. I think this is great. We made $10 million in our last one or $100 million in the last one. I can throw in 100K in to help you out. So they are industry insiders, and what you're looking for is kind of part of your customer discovery calls, your industry calls, your trade shows. Really get yourself inside the industry as opposed to like going on LinkedIn and looking for people who are angel investors, because those people like me are, you got to tell us why there's a return. I actually fill both roles. It's kind of strange. That the way I tend to do my investing is I'm part of these angel groups. We go through the full diligence process. We do an analysis. We kind of look at, is there a minimum 10x return? If there is, then, we'll invest as a group. If it's something that really gets me excited, I'll do an individual investment on top of the group investment. And then we'll, each of my two groups will typically invest in about 10 companies each year. And it's just like all across the industry. A lot of stuff I know nothing about, right? The med tech stuff comes through, I know nothing about it, but we've got doctors in the group. We've got med tech experts in the group. We've got an FDA, former employee in the group. So if they say it's great, fine. Put my money, that's part of my pool. If they think it's really great, then I'm like, I don't know anything about it, but these people think it's great, so I'm going to invest. So that's really just financial returns, and it doesn't matter what it is. It might be a consumer product, as long as it's not something I'm like really dead set against, like like cryptocurrency, then or other things I don't like, then I may invest in it as well. Separately, I do a lot of mentoring in the clean tech space. I work with entrepreneurs who are kind of very early stage. They're not really ready for investment. I can't bring them to the investment groups. They don't have customer traction yet, but I've been working with them for 3 months, 6 months. I've seen them progress over the course of the year. I think they're onto something, and I've got some inside information. I can see they've got some traction. Still early. I like the team, I like what they're doing, and I love the product, right? I understand the industry. I see there's a real need, and so I'll invest in them as well. But it'll be a small investment because I kind of mentally write those off, right? This is it's more like a donation than an investment, right? So I'd love to see them succeed. So I do like a half size or a third size investment in that stage to try to help them get to the next stage where they can go to the angel groups or the big angels and be able to show why it's a great investment. So I do a little bit of both, which makes things confusing, but there are both of those sorts of investors out there.
Well, it gives you exposure to a lot of different businesses and types of businesses,
Absolutely.
which
Yep.
I'm sure is
That's what I
beneficial.
love. Yeah.
So when you're working with a startup and consulting with them, I assume that in my experience has been, even as a development company, people come to me and say, well, here's this thing we want to make.
Right.
And in all honesty, part of that is trying to understand why they want to make it. I
Right.
assume that in investment, there's a kind of a way that you look at their business model, but also their initial pitches, which I've seen initial business pitches are usually far off the mark. So
Yes.
maybe we can talk a little bit about, what are you looking for in a business pitch? What makes a good business pitch for investment?
So what gets the angel groups excited, what gets the VCs excited is customer revenue. And then we don't have to figure out all the other stuff, right? If you are actually selling it, not only does that prove that you can build the product and people will pay for it, but now we can go talk to those customers. And that will tell us, we don't have to just listen to the founder saying there's a huge market for it. We can talk to those people. We can say, why did you buy it? What competition did you look at? How many more of you are there out there that needs exactly this? And we can talk to 2 or 3 customers. That gives us a lot of confidence. When you're pitching
And
something,
for software products, that's
yeah,
a relatively small step. You make an MVP,
yes,
and like you
yeah,
said, we're going. But hard
right,
products or engineered products,
yeah,
that's
then it's
obviously a
tougher.
lot more difficult, right?
Yeah. So in the ones where so there is an intermediate step where they've built we won't call it an MVP, but they built a prototype, they built a pilot system, they've demonstrated the technology scales to some extent, and they have started working with some customer to do evaluation. So again, we have some third party that we can start talking to. If they're before that, they're going to have trouble getting investment from angel groups. Some are a little bit more less risk averse than other ones are, and will invest a little bit early. But you're going to really need to show not that you have great technology, but that there's a big market, that there's not competition that's just going to eat your lunch, that you have the intellectual property to protect. And that you have a team that can build this. And if you can show those things and show that once you build it, there's going to be customers. There's a huge market for it, and then there's an exit for it, because just because you've built a big, nice business doesn't mean somebody's going to want to acquire it. You can show those things, then it can look like a good investment at a low valuation, because the risk is very high. So that will be reflected in the valuation.
Speaking of intellectual property, that's one of the things I am mostly missing whenever someone is pitching me some ideas, or I'm pitching someone else an idea.
Right.
So we usually just end up going around like, hey, I've seen this kind of business working somewhere in some other part of the world, and there's not a lot of competition here. But we always get stuck at that exact step, that there is no IP involved at all.
Right.
And
right.
that feels like a non-starter every time.
Yeah. So there's 2 ways to build a protectable business. One is, I should say there's 3. One is that you have patents that say nobody else can build the same thing as you. The second is that you have some expertise that is going to be hard for people to copy. And that may be, there's 5 of you competing against a giant with 5,000 engineers. But, if you're building a medical device, you may be, the one professor in the world who studied this obscure thing, and that's all that really matters. No one else is going to have that knowledge. And then lastly is marketing. So if you're building a consumer product, the intellectual property you're protecting is your brand name, and you need to be out in front of everybody else. LaCroix is a good example, right? With their flavored waters. Anybody can make a flavored water. There's nothing patentable about it. It's bubbly water with some
Oh,
flavor in
right.
it.
That's
But
crazy.
they
I never
built
thought about
such
that.
a great brand name that everyone's like, I got to buy LaCroix. I got to buy LaCroix. I'm not going to buy the store brand. I'm not going to buy the Trader Joe's version. I'm going to buy LaCroix because that's what everybody wants. And so, they have revenues in the billions of dollars. So, those are kind of the ways to go. Building a brand is really expensive, but that's what you have to do for consumer packaged goods. The easier way is to have a patent if you have some technology. So let me go back again to the VC business versus the non-VC business. If you're building a VC business, you're going to have to show, again, how you get to the $100 million and somebody's going to acquire you. If you don't have any intellectual property, the big guys can copy you. The guys in the garage can copy you. And the fact that no one's copied you yet doesn't mean anything, because just because it doesn't exist now doesn't mean somebody, once you've shown that there's a $20 million business, they're going to line up. Once you start stealing market share from the giants, they're going to be like, oh yeah, we should build that too. And they're going to go work on it. So you need a way of not just kind of flying under the radar now, but protecting yourself once everyone's like, oh yeah, wow, that was a great idea, right? Um, and so patents are the kind of the usual way of doing that in the technology space. For software, software is a little tough to get patented, but you may have, you want some stickiness to what you're doing. For a non-venture business, the idea is being profitable. The idea is to generate profits for yourself, not to get to an acquisition. So it doesn't matter if you have what's a good example? Let's say if you open a fried chicken shop down the street. Well, there's probably 10 fast food places near me, and they're all competitors. Do I care? No. As long as mine is generating profits, I'm happy. If it's, generating $10 million a year, no one's going to buy me out. But if that $10 million a year is generating $2 million in profits, woohoo, I'm doing great. So it's kind of a different mentality of, do I build a business for profitability? In which case, intellectual property doesn't matter. What matters is having customers and generating profits. Whereas if my goal is to be acquired by somebody because I've grown really quick and I have something they can't copy themselves, then yeah, if there's no intellectual property, then you're right, Botond. It's a non-starter.
As a person who's gone through the patent process, there's a saying, patents are only as valuable as the amount of
Yes.
money you have for the lawyers to defend them.
Yes, absolutely. Yeah, and a lot of people don't get that either. I think that's worth a lot more discussion, because they're really expensive to, they're not all that expensive to get a patent, but if somebody copies you, it's, $2 million to $10 million to defend it. And, that's fine if you're Intel fighting against Qualcomm and Apple, but if you're a little startup, you're not going to have that kind of money.
I mean, kind of the only reason for getting a patent or submitting for a patent is because you're trying to get VC capital and you want to say you have IP, right?
Yeah.
But
yeah, because if your goal is not to build a $10 million business, your goal is to build, a $100 million business that's still growing rapidly, on its way to $1 billion business. So you can't think of yourself as a small business. You have to think of yourself as a big business in its infancy. And so you have to be thinking 5 to 10 years down the line. If we're $1 billion business, yeah, absolutely, we need patents to keep out all those new startups that are going to try and eat our lunch.
Let's kind of go back a little bit towards pitches. What kind of are the components that you look for in a pitch for funding? So we've kind of talked about there needs to be some kind of IP or at least differentiation. What are some of the other components of a good capital pitch that
Okay, so good question. That's kind of the thing I end up mentoring all day, every day about, because people send me pitches and I'm like, okay, but. So I divide the pitch up into 3 sections. This kind of goes back to our goal is to craft a story about why this is a great investment. So we start off the first third, and early stage founders, it tends to be 2/3, but it needs to be about 1/3 of product solution market size. What are you building? Why are you building it? Who needs it? The 0 to 1, right? Why are we building this product? What is it? But that's only the first third. That's probably 3 slides. I see sometimes these are 10 slides, 20 slides. The product doesn't matter, right? The investment matters. So that's the first third. Second third is, okay, we've built the product. How are we going to get from 1 to 100? How are we going to build the business? How are we going to keep out the competition? So first third, product solution market size. Second third is going to be things like the competition, intellectual property, team, to show that we know how to build a $100 million business, and revenue projections. How are we going to get to, what's our growth rate to get to $100 million? So those are the things I like to see in the second third. And then the last third is, why is this a great investment? So you can't imagine how many pitches people send me that don't have terms in it. I'm like, well, that's like going to a supermarket and not having any prices on anything in there. I'm trying to invest in things that give me the best risk return. I can judge the risk in a first glance. I need to know what the return is. I can't do that if you don't tell me what the price of the stock is. So, and some things, be like, that's, I don't know, there's something here, I don't know what. You tell me it's, the valuation is 4 million. I'm like, oh, okay, this is very early stage. I get it. High risk, but very high return. Okay, might invest in that. You tell me the same thing as a 20 million valuation. I'm like, yeah, you're smoking crack, right? That's I got 1,000 things I could invest in that have better risk return than that. So there needs to be a slide that shows the exit strategy. Who's going to buy the company? Why are they going to buy the company? How, what size is the company going to be in 5 years? How much is the what are the deal terms here, and how much more money are you going to need, and what are you going to do with that money to get you to the next milestones? I forgot, in the middle is probably a milestone section of what have you accomplished so far. So there's some variability. Some of them can move between the first, second, and third section. But those are the things. I hope I caught them all. There's about 11 slides I tell people, or 11 topics to cover, and you have 10 minutes to do it in. So, and it depends on who you're pitching to. Maybe 7 minutes, maybe 15 minutes, but typically it's about 10 minutes, 11 topics. That's a lot of stuff to cover. So you got to go quick. The idea is not to tell me everything about the business. The idea is to get me excited that we can now sit down and have a 2-hour meeting that gets me really excited that I can spend, the next week with a group of people really diving into it. So don't try to tell me everything. Just try to get me excited that this is going to be that one deal over the 10 years that's going to make investing worthwhile.
A 10-page slide, you got a minute a slide.
Yeah.
You need to kind of talk about what this thing is.
Yes.
And what problem you're solving.
Yep.
Then you got to talk about kind of who you are and why you think you guys can solve it or make a business out of it. And then you got to talk about, okay, well, this is what the business could be, and these are the terms of how you're going to get your money back.
Yeah. Oh, I forgot go-to-market strategy, right? That's part of the middle, a very critical part of the middle. Yeah, there's a lot of customers out there, but how are you going to get to them? So that's also a critical thing.
How do you kind of get a feeling as to whether it's a crowded market, it's not a crowded market? Does it matter? Sometimes a crowded market is fine because they've all been doing the same thing and somebody comes along with a different way. Does that mean much to investors?
Well, a crowded market is not good, right? We'd rather not see a crowded market, and that's usually one of, as we do our discussion afterwards, sometimes people stand up and say, well, that's nice, but that's a crowded market, and we're like, okay, so it's going to be a difficult investment. So there may be some other people doing something that isn't quite the same thing. It's nice that there is some validation. There's a market here, but we don't want 20 startups all working on the same thing and a couple big companies with big teams that can jump in and eat your lunch. So yeah, crowded market's not good. Something new, different, that you have some unique expertise and some unique insights on, and some key intellectual property is going to make for a more exciting investment. Now, so in a group like Tech Coast Angels, where there's 150 of us, but we're hearing pitches. I mean, we're an angel group that's kind of specialized in being part of the Los Angeles startup community. We hear everything, right? Everything from organic cider to med tech cancer drugs to a lot of software. But we've heard women's handbags, right? It can be anything. Didn't invest in that. We did invest in the organic cider. Not a good investment, but but it can be anything. And so we kind of count on there being somebody in the room, and hopefully more than a few people out of those 150 that have some expertise in that space. And we don't have anybody in the group that has some expertise in the space who can really dive into it and lead the deal. Then we're probably not going to get involved. Unless they come from another angel group and there's people there that we trust, and somehow or other we can't evaluate it without having some industry knowledge. And if we don't, then fine. We'll sounds great, but we can't pass. So I personally don't invest in med tech stuff or life sciences because it's a specialized world, and I don't know how to evaluate it. I don't know how to I don't know what other people are working on. The great thing about Chemical Angels is we specialize in things related to chemistry and materials. Most of the group is like PhDs in chemistry. They work at places like 3M and BASF, and so when somebody comes in with something that's chemicals related, it's like, yeah, we either know a lot about it, or there's somebody in the room who kind of looked at it. We know who else is doing what. We kind of know what was invented. We can actually dive into the intellectual property. So, I really like the specialization group. And the best is when we can combine the two, right? When we get somebody pitching to one angel group that will be like Techos Angels, and we're like, well, that sounds great, but we don't have anybody who's an expert in batteries, for example. But we want you to pitch to this battery group because there's an angel group that does nothing but batteries. And if they're excited about it, we can look at the market size, we can look at the financial stuff, we can look at the team. We have these people who are specialists in technology and the industry, and so there'll be some cross fertilization there that I think is incredibly valuable. Whereas the VCs kind of do it differently. They have money, right? We're investing our own money. We're volunteer groups. We're just kind of really technically there's probably not a nonprofit organization around it to run the operations, but fundamentally we're just a bunch of people who get together to jointly invest in things, and so we don't have money other than our own. Whereas the VCs, they are, that's a business, right? So they collect 2% fees. They get money from big organizations like universities and insurance companies and pension funds and things like that, and they'll bring in $100 million, and they take 2% of that a year to run their operations. They have $2 million a year for a medium-sized fund, and then they keep 20% of the upside profits as well. But they've got $2 million. Some of that will use their own operations. They take salaries, they're full-time people, but then they can also hire consultants. So somebody comes to them, pitches a battery, and they're not battery expert. Well, they can hire a battery expert as a consultant to come in and look at it. And some of the angel investors will actually work for VCs as consultants as well.
What kind of terms are investors like angels or small VCs looking for? What would you consider reasonable terms?
So there's kind of two separate pieces. One is what the structure of the investment is, and the other is the valuation. So structure, your choices are usually either preferred shares, and that's what investors like, but it's expensive, it's time consuming, there's a lot of lawyers involved. So unless you're getting a big investment in, like $2 to $5 million or more, you probably don't go with preferred shares. In that case, your two options are going to be the SAFE agreement or a convertible note. Some investors hate safes because the old safes were horrible. The new safes are great, but a lot of people haven't gotten the memo yet. So some investors will just say, we don't invest in safes. I've also seen a lot of safes that don't have deal terms in them. They're just, we give us money and we'll get a discount off of whatever we end up negotiating 5 years from now. So I don't like those either. But a post-money safe, that's kind of the technical term, post-money safe with a valuation cap, I think is the best investment. A lot of people disagree with me and they say, well, we prefer to have convertible note because that gives us more flexibility and we can add in, special terms in there like liquidity preferences and stuff like that. So kind of the angel community is a little bit split. I like SAFEs. A lot of people prefer convertible notes. I think either one is usually acceptable. Preferred shares are better if you're at the stage when you can do it. In terms of valuations, that depends on who you are talking to and what stage. So friends and family, typically 2 million to 4 million sort of valuation. Your first round of investors, 4 to 6. When you get to the angel groups, it's like 6 to 12. When you get to Series A, it tends to be around 20. But there's a wide variation, and it keeps changing every year. Last year was just an insane bubble, and so we were seeing, pre-seed rounds at $20 million, and like, we're not going to make any money from that. But they were getting investments, so great. It's kind of come back down a bit, but not all the way where it was. So valuation really depends on the details. It depends on the market size, depends on the team, depends on the traction. It's hard for the entrepreneurs to know what their valuation should be because it's not a spreadsheet calculation, net present value sort of thing. It's really kind of an auction of how you compare to all the other investments that we can invest in. So the only real way to figure out what your valuation should be is to talk to investors and say, what terms would this be attractive to you? And there's kind of those two steps of there, especially when you get into not the original friends and family and kind of industry people, but after that, usually there's a lead investor. The lead investor's job is to negotiate with you what the terms are going to be. Once the lead investor has set the terms, you have a signed term sheet, then they'll take somewhere between a quarter and half of the deal. Then you bring in the other investors who are just like, okay, that's the terms. We'll either invest in that or not. And then the lead investor will usually end up being on the board, or at least a board observer, and kind of represent all the other investors. So yeah, the terms, it's really tricky. And one thing I think is interesting, it depends on what part of the country you're in. Not just what country you're in, but if you're in the Bay Area, valuations are higher than Los Angeles, and that's higher than, say, Indianapolis. Just because there's more money, it's an auction, right? So there's more money, there's more people investing, so valuations tend to be higher in San Francisco than they are in LA.
So if I were to take an investment, am I going to lose the house if I lose the company? Just to put it in the simplest terms possible.
No, you shouldn't be mortgaging your house unless you're doing a loan. If you go to a bank, they will ask for the house as security. You go to the VCs, we kind of work differently. We're investing in that business, and that's it. But on the flip side, we don't want you taking a big salary because then you're kind of sucking money out of the business that we want invested back in growing the business. So no, you don't lose your house, but you will lose your the business goes kaput. You're back to zero, and you have to go off and find a job or start another startup and get more funding.
I have a feeling that a lot of people go for the second option, to start the next startup, or next Kickstarter.
Yeah. We hear a lot of people saying, "Well, the first one failed, but I learned so much from it. Now I know everything we need to succeed." So the other people have paid for my research, and now you get the benefit of. Yes, that's a pretty typical story, and it works. One of the nice things about Silicon Valley is, failure is considered a learning experience as opposed to something gone wrong. So, and most founders have failed. I've built 5 startups, only 2 of them have been successful. So I don't say I've failed 60% of the time. I say I've got 2. I built 5 companies and had 2 successful exits, and everyone's like, "Oh wow, you have 2 successful exits? That's huge," So. That's kind of the way Silicon Valley thinks. There's nothing wrong with failure. It won't stop you from starting your next one.
All right, Botond, do you have a kind of a final question for DC on this?
I mean, I might have the perfect final question, DC. What does the future of investing look like?
Wow. No one has ever asked me that, and that's like the perfect question because VC has been there forever, but it's kind of exploded recently, but a lot of people who probably shouldn't be doing venture investment or doing venture investments. There's a lot of people are going to lose some money, so we'll probably see some pushback. I don't see the venture world going away. It's a business model that works for a particular sort of business that's going to grow rapidly. What we need more of, has always been frustrating, is a funding mechanism for the companies that are looking at profitability. And that's really the majority of startups that I see. They call themselves startups, but they're really more like small businesses that need a way of getting $1 million to build a product, get themselves out there, and then generate healthy returns. But that doesn't fit with a venture model. So I would like kind of come back to the Shark Tank model of, right, is there a way of like paying back investors early, kind of so as a mixture of it being like a loan with some amount of money coming out of the revenues, and then, but also keeping the equity as an upside stake with some way of doing a buyout, because we don't want to just sit with equity for 20 years. So some way of having that converted to money afterwards. And then there's venture debt, which was kind of taking off, and that's great if you have if you've got $10 million in revenue and you need another $10 million. A big bank will give you a loan. The Silicon Valley Bank was kind of big people in that, and I think they were a little bit too aggressive, and that's one of the reasons they ran into problem. So I'm kind of hopeful that there are more hybrid, as more people get into this, and it's not just a few venture firms with big pots of money that have to invest $10 million or $100 million at a time, that there are some more hybrid models that kind of make funding more feasible for a wider group of startups. But unfortunately, it's not there yet. That's what everybody wants, and that's what everyone's hoping from investors. That's what everyone thinks it is from watching Shark Tank, but it's still pretty rare.
In the intro, one of the things that caught my eye a little bit, because I do a lot of writing myself, is that you are a published author and novelist. Maybe you can tell us a little bit about that.
Oh, absolutely. Thanks for giving me a chance to mention it. And by the way, I happen to have a copy of my novel right here. To Kill the Unicorn is a mystery novel about Silicon Valley, a bit roughly based on Theranos. If you're familiar, I guess Elizabeth Holmes just went to jail yesterday for her fraud. But imagine if a startup wasn't just a fraud. Fraud's easy, right? We're just going to hide things. Imagine if they had this really great product, but it had some bugs in it. But that product was worth $1 trillion. Now, would you go off and tell investors, just hold off for 5 years till we figure out some solutions? Maybe there is solutions, maybe there isn't solutions. Come back in 5 years and, we'll see whether this is worth $1 trillion or not. Or would you just kind of hide that in the back room? And, maybe it kills a few people, but, okay, but it's $1 trillion, right? So this is about a startup that's doing some very suspicious things, and they've promised that they're going to revolutionize transportation. They've got this great technology, but now the chief scientist is missing. And his friend, who is a hacker who works at a company that's kind of similar to Google, needs to use his hacking skills to figure out where his friend is, which means figuring out what's going on inside this company. So it's a bit of a farce about Silicon Valley, but it's also a little bit of science fiction. But fundamentally, it's a noir mystery. So I tell people there's a lot of books about building startups and Silicon Valley. This is the most fun you will actually have reading about Silicon Valley. So I try to make it a fun, crazy story about startup life, and it really appeals. I mean, the money the business plan for this book was not very good, right? If you want to make money at a mystery, you write for the mystery book clubs, which, like their cozy mysteries, tend to be, the ladies in their mystery book clubs. A lot of money in that. This book was written for people who are in the startup community. This is for founders. This is for programmers. This is for developers. This is for people who live and work in the Bay Area or just kind of connected to the startup ecosystem with something that I think really tries to show it from the inside, and hopefully we'll find humorous there's a lot of engineering humor in there too, like a lot of Hitchhiker's Guide to the Galaxy references and things like that. So thanks for giving me a chance to mention it, and hope everybody is now excited about it. You can find it on Amazon, like everything else, To Kill a Unicorn.
Oh, cool. No, it sounds like a fun read, and it sounds like something that would be enjoyable. And obviously, it's a passion of yours for writing.
Yes.
Are you already started on your next book?
Oh, so the next book's already finished.
Oh, okay.
So the sequel to this book is already finished. I'm waiting for it to go through editing and be hopefully come out later this year. I'm now working on my third book, which is completely different. It has nothing to do with Silicon Valley and these characters. It's about Japan and sake brewing. It's more of a traditional mystery, going back to that business plan of how do I actually write a book that will make money. This is an Agatha Christie style mystery of a group of people going on a tour of sake breweries in Japan, and one of the people on the tour dies after eating blowfish fugu, and obviously one of the people on that tour was the murderer, and you get to find out all these suspicious things that all the people on the tour are doing. So working on that one now.
Well, DC, it has been really great talking to you. Thank you so much for helping us see the money and some great tips on creating a fundable business model and funding presentation. For our listeners, please join us in the first week of next month for another ScreamingBox Technology and Business Rundown podcast. And until then, keep focused on finding the money.
Thanks, Dave.
Thank you very much for taking this journey with us. Join us for our next exciting exploration of technology and business in the first week of every month. Please help us by subscribing, liking, and following us on whichever platform you're listening to or watching us on. We hope you enjoyed this podcast, and please let us know any subjects or topics you would like us to discuss in our next podcast by leaving a message for us in the comment sections or sending us a Twitter DM. Till next month, please stay happy and healthy.